And before we get started, I just want to do a quick shout out to Media Shares. You see this wonderful video that the gentlemen there are doing. It's going out online. I think they're doing a phenomenal job. We've had thousands of people watching online, and you're obviously in this room can see the job that they're doing on the screens here. Phenomenal job, and thanks a lot to Gene from Media Shares for putting that together. So now we're going to have the online lending technology panel. We've got pretty much all the leaders here in the technology space on this panel, and it's going to be moderated by my good friend and Lend Academy and LendIt partner, Jason Jones. Over to you, Jason.
Welcome, everybody. Welcome to the online technology panel here at LendIt. I'm Jason Jones, a co-founder of LendIt and a co-founder partner at Lend Academy as well. Today we have a really great panel of some of the leading technology companies in the P2P and online lending space. We have 3 companies that I would define as order execution platforms. We have 1 company that is a secondary market, and we have 1 company that is a market data company. They all do technology, so they have many different other areas of products and services, but if I had to define their core, that's how I would define them. All right, so I'd love to start with the 3 order execution companies on the panel here: Orchard, Nickel Steamroller, and Nodex. Maybe each one of you guys could give a 2-minute background on your company and how you position yourselves, and we can kind of hear the differences between how you approach the market.
Yeah, so I'll start out. My name is Matthew Burton. I'm the founder and CEO of Orchard Platform. We're a technology service provider in the space, and we build technology products that help both the institutional investors and the originators scale their business. And so order execution is one small piece of our technology offering.
Michael Phillips, founder of Nickel Steamroller. We started in June of 2011 as a data aggregator for Lending Club. We then moved to Prosper. The order execution aspect of Nickel Steamroller started out from a retail perspective, and that's when retail made up about 70% of the market. Right now the market shifted quite a bit. By my estimates, it's probably anywhere from 80 to 90% of orders. So our focus has really been on the order execution side for institutional.
Hello, my name is Simon Hermes, and I'm the co-founder of Nodex 360. Nodex 360 is focused on aggregating lending products and providing order management and execution. We look to aggregate both peer-to-peer and broader alternative lending products, and we have 3 product verticals: consumer, unsecured, corporate lending, and asset-backed lending.
Luan, could you tell us a little bit about market data and why market data is important to CrowdNetic Lendis?
Sure. I'm Luan Cox. I'm the CEO and co-founder of CrowdNetic. And we provide an unbiased, transparent marketplace for both the equity side of the crowd finance space and also, obviously, peer lending. And launched yesterday, LendVias, which is the kayak of the peer lending space. And our goal is really to sort of level the playing field, make the pie bigger for everyone, and empower borrowers and investors alike.
Okay, and Steve, could you briefly tell us about Folio FN's role in the P2P and online lending area?
Sure. My name is Steve Wallman, CEO of Folio FN. We're actually perhaps the odd man out here. We're actually a clearing broker. I think probably the only clearing broker in the country that's working in this space in a deep way. We have both the technology to enable peer-to-peer as well as the ability to actually custody assets, hold cash, hold securities, allow across multiple platforms people to be able to buy into a variety of different platforms, different kinds of securities, equity, debt, hybrids, and others. So it's a somewhat comprehensive offering. We've been in business for about 15 years.
Simon, could you start by telling us a little bit about the order execution process? Take us through the steps from when the loans are loaded through the API at Lending Club through to the time that loans are actually purchased.
Sure. We're constantly polling all the different originators that we aggregate with, so we get all their inventory as soon as they become available, and they're exposed either through our set of APIs that provides direct interface with our OMS, so it's a direct market feed, so direct market access, and they either score the loans. If you're a hedge fund, you have a credit model, or you have a filter strategy. You select the loans, and either you fill the orders and send it to our API, or we generate the orders for you based on your strategy that you've subscribed to, and then we send it to our OMS. Our OMS handles all the orders that come in, and it checks it to make sure it's standardized, so it's a standardized order, and we check it to make sure that all the fields have been filled correctly, and we schedule it and we route it to the final platform for settlement and execution. And we basically provide transaction level data and reporting level data all through our OMS.
And how does Lending Club differ from Prosper? From the API?
API, all right. So it's a key point that each originator has a different protocol and different technology that you have to maintain. So Lending Club is a SOAP base. So in order to submit an order, you can put multiple listings in one order. As opposed to Prosper, you have one order per request. So it's easy for somebody to game the system with Lending Club by submitting 100 orders at once, because they only have to submit one request. And if you're at Prosper, you can submit 100 different requests at a time. So it's a lot harder to game the system by trying to buy up as much as you can with one request, because you have to submit 100 independent requests with Prosper and one with Lending Club.
So if I can jump in for a second, with the Lending Club implementation, they do allow you to pipeline orders. So let's say I've got 25 loans I want to buy. One of the issues with pipelining orders is you need to make a decision on every single one of those orders before you actually do the execution. The way Prosper does it, they only allow one order at a time, but as you're making decisions on loans, you can fire off a request to the API to actually go out there and then purchase that loan. So with pipelining on Lending Club, it's a nice feature, but you may be putting yourself at a slight disadvantage in terms of timing with other investors.
Matt, how would you, when you look at the market, what category of investor do you focus on, and what services do you provide?
Yeah, so broadly speaking, it's institutional investors. So that's anything from a family office to a BDC to hedge funds. And we're really helping them with everything they need to do in the space, which is the first piece is a lot about education. So for all the technology providers, we're very high touch. And so we talk to our clients every single day. And so helping educate them on what the current opportunities are, and especially where we need to be in kind of 9 to 12 months as well, and building towards that. So the education piece is normally the first piece that we provide. Then we go and sit down and talk about what is their investment strategy for the space that is unique to them. Which platforms do they want to interface with, and help them make those connections so that they can get the right contracts in place. And then kind of all the way through the process of order management and reporting to where we're actually working with their fund service or their custodian to automate all of the kind of back office piece. And so, for the institutional investor, that's the product suite. And then on the origination side, we help originators connect to institutional investors and select who they want to do business with and provide them with a technology platform. Because we see that today, there's not that many platforms who have reached a scale where they have an API and it's easy for them to interface in that way. A lot of traditional finance companies and even some of the smaller online guys need help with technology as well.
Mike and then Simon, are you also seeing that you're finding platforms that may not have a fully developed API and you're kind of figuring out solutions for those platforms? That's
correct. I mean, typically when a platform has an API, they're ready to scale, or at least they're indicating that way, because in reality, if you're only generating a few million, a month, the API isn't that necessary. It's when you want to have large volume and you want people to automatically sift through all the loans and execute. So when the platforms have to have, it's more beneficial when they're at a certain scale for the API. But yeah, we provide guidelines to a lot of originating platforms. They can go ahead and do that. And we provide some basic guidelines at a minimum of what's required in terms of architecture and data. And that's something we provide. The decision's, up to them and what they want to do.
So we're interested in the API from two perspectives. We obviously aggregate data. So if you want to know what percentage of loans are going to whole versus fractional for Lending Club or Prosper, you can find that information on nickelsteamroller.com. So the API is capable of providing us that data so we can aggregate it and then provide it to the public. And as well on the order side, in the last 2 months, we've probably spoken to 3 companies who I think are getting pretty close to making that step, getting to the API. It's something the institutional investors certainly are interested in, with the expectation that at some point they're going to need to scale.
Do you think there's going to be an industry standard kind of API solution, or will there be kind of will each one of you kind of develop your own proprietary kind of solution that you kind of market to the various platforms?
I mean, I think in this to standardize, our architecture is pretty open, so we still pass through the same sort of data that you get from Prosper Lending Club, so people want to parse it that way. We do some data normalization, but it's really hard to do when you have so many different platforms. So we use a REST-based protocol, so anybody can access that, and it's very common, very standard. I think we tiptoe in how we standardize. You don't want to jump in because the market's still very green and it needs to evolve. People need to experiment and to find what's the best optimal solution. So we don't want to overstep at this point.
Yeah, if I can just jump in, I mean, standardization is critical, and I think that everyone has the Lending Club and Prosper APIs. I mean, we've integrated those. We have an order management system live on LendVias Pro now. I think one of the things we're trying to do to empower and enable some of the other portals who may not have APIs, and most of them don't, as we know, is provide an easier way to at least get some distribution. And what I mean by that is we actually work with them even on a manual basis to get their deals up, out onto our sites. And for example, we have a relationship with Dow Jones Market Watch, where we've put up Realty Moguls deals and Patch of Land. So to the extent a partner just can give us XML for now, we sort of owe it to the industry to do that. But yeah, in terms of, standardization, in terms of, there's a fixed protocol in the financial industry we have to have that in the pure lending space. And I've known Steve for many years. He's a big proponent of standardization as well. So.
Crowdnetic is interesting because you cut across equity crowdfunding, real estate crowdfunding, PPP lending. Are you looking to develop some type of tagging system or naming convention for every deal originated on every platform?
Yeah, great question, Jason. We actually have. We tackled the problem first on the equity side with Jobs Act and Title II implementation last year, and what we've built into our data platform, we've done the same on the lending side, is what we call a Crowdnetic issue identification number for equities and a Crowdnetic loan identification number. So every single loan that comes through the API, the Prosper and Lending Club APIs, and through any of our partners, gets a CLIN number attached. We're also working with Thomson Reuters to standardize that. And get it out through the industry. So yeah, we're just applying everything that we've done for the equity side in terms of data taxonomy, standardization, issue identification numbers up to EIN to the pure lending space. So it was easy for us to sort of extend the platform.
That sounds a lot like a CUSIP number to me. Where do you go with that? What is the business that forms around that?
Well, that's got to be a collaborative thing. Obviously, Standard & Poor's invented the CUSIP. They ended up being able to make a bunch of money around it. I think for us, it's not about money. It's about working together. I know the Wealth Forge guys have Crowd CUSIP that they did with CUSIP. We're collaborating with them. So I think it needs to be open source. Here are our identifiers. I'm sure these guys have them as well. We need to be talking to each other.
So
we have a similar view with regard to both the mission and sort of the underlying construct for how the industry, I think, needs to and can evolve over time. We started with XML, we started with SOAP, with SOAP APIs. We have a full suite now of REST APIs. The question that I think comes up is how much standardization basically also can stop innovation and how much standardization helps facilitate innovation. Our mission is to facilitate other companies in doing what they do best. So we have about 500, a little less than 500 financial firms currently on our platform, from global financial firms that run specific offerings off of our platform to startup companies that run off of our platform. And we've done what we can to try to help standardize. Our private placement platform, for example, uses the equivalent of a ticker, if you will, for allowing people to trade private placements and to be able to invest in them. So I think the discussion here makes an awful lot of sense of how do you start to get the data out so that it can be useful across different platforms? How do you get scale into the system? How do you also ensure that people can do that without stopping the next innovation that comes down the pike? Because we've seen an awful lot in our years, and it's a terrific thing to encourage and facilitate that innovation and to enable people to be able to build new things.
I'd love to hear from you. What is the history of the Lending Club and Prosper relationship? How did you get into building the secondary market or operating the secondary market for both of those businesses? And where does it currently stand today?
We're the underlying regulatory ATS, alternative trading system, for both Lending Club and for Prosper. But Lending Club and Prosper each own and have their own technology. That's their competitive advantage for each of them. So they maintain the competitive advantage of their technology. And whether people like it or don't, certainly some have raised some questions about whether or not that could keep pace with perhaps new innovations. The technology is theirs. We're the underlying regulatory infrastructure, if you will. We're the alternative trading system that's regulated with and registered with and regulated by the SEC. We do the reporting, we do the filings, we do the custody, if you will, in terms of the actual underlying capability to make the whole secondary market work. There's an awful lot that goes into the regulation and also the reporting, the tax reporting, the compliance, the servicing, that I think it's grossly underestimated in terms of the enthusiasm for starting new enterprises. And part of what we try to do as value add is to facilitate that. When Lending Club and Prosper both had certain regulatory issues a number of years ago when they were beginning, there was a determination by the SEC at that time to ensure that there was a robust potential secondary market as well. And part of that was the requirement for an ATS, and we were able to step in and supply that so that they could get back up and become as successful as they had been, which is really enormous.
As your role as can you tell us a little bit about the clearing brokers, their role in the industry, the role of the DTCC, and how that kind of structure could apply to P2P lending in the future?
Yeah, when you think about what the equity markets are like, DTCC, and also on the debt side as well, you end up with central facilities which enable a lot of the communication and the scale effect that makes the industry work. Without that, without those utilities, the industry would be so balkanized and so expensive that it would be impossible to operate. If you think about where the current sort of private placement equity business is, it's actually in a relatively similar space to where the sort of lack of an industry utility would have been for public equities decades ago. And what's happening very, very quickly, not taking decades to get there, what's happening very, very quickly is technology is allowing, in part through APIs, in part through connectivity and connections with other people doing various things, in part through people like us who are able to and willing to be the underpinnings, if you will, for people being able to innovate. You're starting to see that efficiency built back into the system, even on the unlisted side. So whether or not it's securities that are registered, such as Prosper and Lending Clubs, which are under an S1 registration statement but are not listed, whether or not it's privately placed equities that are not listed nor registered, exempt under the Jobs Act or otherwise, you're able to start to bring some of the efficiencies that the public markets have been aspiring to for a long time into the unlisted and the private markets as well.
Interesting, thank you. Switching gears, Matt, you came from Google and decided to enter into the P2P online lending space. It's an interesting move. Could you tell us a little bit about why you made that decision and what you've learned at Google and you've applied to Orchard?
Yeah, so I think that the big lesson learned is what things look like at scale. and how different the space is going to be in 12 and 24 and 36 months. When we were putting the team together, that was a huge focus. We kind of have a mix of, a lot of my old colleagues from Google, as well as, some leaders from have backgrounds at Bloomberg and other kind of more fintech type companies. And that's kind of the big focus for us, is making sure that we're preparing ourselves and building the right components that allow the industry to double and double again without things breaking. And so, when we look at that, there's a lot of components that are completely missing that we're having to fill that out. One is the secondary market. So we have a no action letter to the SEC to help provide that technology layer, because it's very obvious that as the platforms have to scale at the rate they are, it's difficult for them to be able to focus on many things at once. And so I think that one thing that's happened is the secondary market has not had a whole lot of innovation on it to date. And so we're hopefully going to help fill in that gap. We also released the industry's first index yesterday, which is kind of another important component. And we'll continue to kind of build those types of pillars that will help kind of the space double and triple in size. And it's really operating with that mindset that whatever's working today might not necessarily work in 9 months, and making sure that our clients are prepared for it and we're prepared for it as well.
Interesting. It's interesting, Steve, you currently run the regulatory framework and the operational framework for the two secondary markets, Lending Club and Prosper. Matt, you're interested in building out a new secondary market for both of those platforms as well as others. Tell me a little bit of, I know, Steve, you're not actually operating the technology, so I'd love to hear from both of you. What's deficient in the current system, and what can be done better if a new secondary market were to roll out?
So we're not actually focused on building technology for retail investors. And so the secondary market that we're building would not actually apply to the current state. We're focused on where we think the larger pain point is, which is institutional investors have no liquidity in the space. And so that's a big constraining point when we're talking about launching, funds of, it's okay if the fund is 25 or 50 million. It's completely different if they have lack of liquidity and they're $500 million funds. And so that's kind of what we're focused on that side. I mean, I think because of the regulatory issues with a retail secondary market, it's really up to the platforms to invest in that side.
From our perspective, we've spent a good amount of time trying to work through with various regulators some of the issues that come up in both secondary markets and otherwise in new spaces. There are some regulators that are perhaps still looking to the past for their guidance, and that's not necessarily fully informative of perhaps where they should go in the future. And that has been an interesting effort. Sometimes we take it on the chin from the regulators because we are out there basically defending innovation and defending new entities and trying to make sure that their innovations are not stopped. And we can act to help facilitate. We don't always succeed, but we can help facilitate that in many cases. The issue with regard to the secondary market is, I think, one that has to be looked at in a more granular light. A secondary market for some securities, when the duration is very slight and short from anybody's perspective, starts to serve less than a useful purpose, especially when the costs and the transactions costs are included in it. Longer duration securities, secondary markets are imperative, and they make an awful lot of sense. When you get to certain of the private equity securities, secondary markets become more interesting to think about because they're, unlike the standardization and the ability to, for example, ultimately even think about securitization for the peer-to-peer lending and institutional lending side. When it comes to the equity markets, unless you've got very good diversified portfolios, which we specialize in and help put together, it becomes harder to think about a securitization concept there, and liquidity becomes a more daunting task. The valuation of each individual equity actually becomes itself a more difficult thing to do. especially because exits become different, terms become different, and there isn't yet standardization in that field. One of the things that I think Luan is helping to put together as the tagging and the standardization starts to come into the fore more is to attempt to standardize some of the actual securities themselves. That will, I think, make a major difference in the secondary markets in the non-lending side, in the non-debt side, but in the equity and the hybrid side. So the secondary markets are very different depending on which one you're looking at. Both within sort of the debt side and also when you get across security types into more hybrids and equities, there are a lot of different issues that come up.
Okay, and where does securitization fit into the vision of your secondary markets? Clearly, we've seen Eagle, SoFi, Insight, and on deck recently securitized. That's at the institutional level. So how do you
it's much easier. Much easier. Yeah, I mean, when you get to institutional level, medium to longer term security debt type securities, securitization is much, much easier. Much easier to do, much easier to accomplish, much easier to sell, much more interest in it. When you move to either very short term or if you move to hybrid or equities, it's a somewhat more interesting issue to see how to best do that on an efficient basis. Doesn't mean it won't get done. It will get done. This industry will expand. This will be mind-boggling and really sort of very changing for the markets generally. It will be, I think it will be an enormous innovation. It will help a lot of people raise a lot of capital. It will do the things that the Jobs Act was actually designed to do. I firmly believe all that, but it will take some time to work out and some innovation and some creativity to think through how best to make some of this work.
Switching gears, Luan, Michael, you both focus on data, on building tools and data analytics tools specifically. Tell me a little bit about how your users are using those tools and what are they designed for?
Sure. Probably two of the most widely used features on the website would be the portfolio analyzer and then the backtesting tool. The backtesting tool is just what it sounds like. If you just go to the page and you hit filter, what we'll do is we'll attempt to calculate by discounting, depending on how late a loan is, what the anticipated rate of return will be for that loan annualized. We allow people to break it down by inquiries, state, employment length, and then vintages. We basically support every breakdown that they have in terms of data they provide. So a lot of people find this valuable when they're kind of looking for inefficiencies in how they're pricing risk at the platforms. And I'll have to say that both platforms are obviously getting much better at this. And I do see a point in the future, where an A is an A is an A. I don't think we're quite there yet, but that's certainly the way it's moving. The portfolio analyzer, people who have LendIt Club probably noticed LendIt Club added an NAR return where they do essentially what Nickel Steamroller does, where they discount your rate of return. And what it does is, a lot of people sign up with new accounts. They see these 18% returns. They're telling all their friends about it. 4 months later, the defaults start to roll in, and then they kind of get a better picture of how this asset class will perform for them over the long run. What we attempt to do is allow them to understand that late loans have a certain percentage of not paying, and that's what we attempt to capture in the portfolio analyzer and as well as the backtesting tool.
Yeah, so we've always been very focused around providing transparency and taking what is not a very well understood asset class, again, on the equity side and for peer, to the masses. And I mean, we've been in the financial data and web solutions business since the 90s, and we understand, we were the first to bring stock quotes onto the web. So we understand that people need to look at data visually. So we've got, and obviously we just launched LendVius yesterday, so I don't have a whole lot of statistics, but just in LendVius alone, within LendVius and LendVius Pro, we have over 50 different charts, for example. Our screening tool screens over 75 different criteria, and we try to take it to the lowest common denominator in terms of what someone, my grandmother might be able to understand, all the way up to an institutional investor. But in terms of tool sets, I mean, just being able to look at data, information, apples to apples. And clearly right now, where there's two platforms that have the bulk of the data, it's not that big of a problem. And this is why, because there's only two platforms. This is why standardization has to happen in terms of the data. We're working towards that. But so now our job is easy, and we're just making it easy for people to understand the data through graphs and screening tools.
Just go into a little bit more. You launched LendIt yesterday. Tell us a little bit about what the goal is, what's the vision of LendIt?
Yeah, so we're trying to solve obviously a big problem in the industry. There's plenty of great companies like my colleagues here focused on the investor side. We've checked that box with LendVias Pro, but in talking to participants, we know that the borrower side, the inventory is low. And we're in a very unique position to sort of help in that area. So LendVias Pro is really about, LendVias is really about being the kayak for both borrowers and investors, and educating borrowers, because 99.9% of America doesn't know that the peer lending space exists. We know that. So let's start to educate them through one place. So we are in the process of onboarding some very interesting partnerships so that the borrower can be walked through sort of a path, and we can hand them off to the appropriate provider. But we don't want to discriminate. We want all peer lending providers on the platform, and we want to present them objectively.
Simon, you guys recently made some inroads in the UK. It sounds like you're focused a little bit internationally. So can you tell us a little bit about, you started with Prosper Lending Club, but what's the roadmap?
Sure. Yeah, we are keen on with Funding Circle UK. We haven't integrated with them. They'll be later this summer. They're releasing their API, I believe, next month. So our vision and the difference with our companies is our clear focus on aggregation and execution. And we're going to look to expand globally in the UK and in Australia, and in Europe as well, and while in the US. So our core market's US, and then we'll go into each new country with an anchor platform like Funding Circle UK and start to see what other platforms are originating good product that our clients want. So now an investor can access our OMS or integrate our OMS in their existing technology and be able to deploy capital globally. So if you think Funding Circle originates a loan, they can have it funded from somebody in Shanghai, Sydney, and London in a matter of less than a second. So that's bringing that global crowd to each platform. And we're offering that as a technology product. As far as analytics and models, we've taken the approach that we would like to partner with analytics providers and model providers. We've just signed a licensing deal with a provider of credit models that he's going to be releasing one in July, a high-grade model for Prosper that we have integrated directly into our OMS to provide that type of solution if clients want that. So we have more of a partnership model as opposed to trying to do the full stack ourselves. This frees up capacity so we can focus on our core competencies and keep costs low, which is aggregation and execution.
That's an interesting point. Maybe the three of you can comment a little bit about integrating independent credit modelers onto your platforms and how that works.
Go ahead.
Sure. We use something called modalities for making investment decisions. There's and I'm sure if you've used the website, you've seen there's just your plain filter. So if you just want to do a passive index of straight C, you just check C, you save it, and you can automate it. That's one method of investing. We also have one that's called formula-based investing, where you can take certain credit attributes and perform certain algorithmic transformations on that data to make an investment decision, and we have what you see is what you get editor for that. The third model or modality is actually doing models. We've got a pretty loosely coupled way to integrate with models because there's no standardization at this point. We can accept basically a black box model. You've got some C application. As long as we can feed you data and we can agree on what you're going to give us back, we can integrate that way. We've also just developed a Java SDK that you can use to develop models for against our platform. So those are basically the three ways we integrate investing decisions into that platform.
Yeah, I mean, today we are really focused in working with our clients to help them create a custom strategy. And so it's a very hands-on approach. I mean, when you're in the institutional investor pool, there are restrictions that are put on top of you by the platforms as well. You must buy X amount of AA's and A's and B's and C's. And so really what they're trying to understand is, with those restrictions, can I hit my investing goals? And each client is different. A family office doesn't have the same risk appetite that a hedge fund might go after. And so it's really working with each client to understand kind of what are their goals and how can we help them achieve them. Additionally, we have been approached by some risk modelers who are interested in hosting their models on our platform, and we're looking into that today. But today it's all custom.
And then just going back to like the open standards, I mean, I think there's opportunity for standards everywhere, including modeling. Right now, there's nothing that exists, but at some point, I could envision, basically commodity models that kind of go around to these different platforms and can be deployed. I think we're all going to get very good at this, and we're all going to be pretty much at the same speed in terms of execution. It's going to become more of a cost game, an efficiency game, and a reporting game. And those are going to be the differentiators. So I envision there's this concept of vendor lock-in. It's happened with like Microsoft and these other companies, but going to an open standard even for modeling, I think would be a really good step for the industry.
I also think that people focus on the credit models a lot today, and then think that that's actually going to drive a lot of alpha in the space. And when you do this day in and day out, you realize the problem is not the modeling side. The problem is there's not enough supply on the platforms. And so until Lending Club and Prosper and others are able to find borrowers at scale to actually fulfill what is the demand today, chopping it up in a better way doesn't really push the industry forward. That's not going to double the size of the industry as if we improve on the credit modeling side. So I think it's important to keep that in perspective, that it's really, the need today is additional supply.
And that's actually what we're focused on solving. So we're looking to bring product online, not from just peer-to-peer platforms, but also alternative lenders who are originating auto loans and need to offload inventory, merchant cash advance who want to offload inventory. And typically these firms sell to banks or other financial services companies, and we're trying to build pipes to allow it to aggregate to hedge funds. Now hedge funds can access a lot more volume as opposed to being constrained on Prosper Lending Club. So they can access $10 million a month in auto, or $5 million in merchant cash advance, or invoicing product, in the UK or in the US. So that we're targeting these different platforms to aggregate as much product to make it available, and not just being constrained with just peer-to-peer, because everyone's going after the same product and competing for the same thing. And our goal is to increase the market size, increase the pool, and make it convenient, and reduce the technology barriers and the costs for accessing a larger pool of inventory.
We actually see that same phenomenon as well. When you look at the public markets, which is where most of our assets are by far at the moment, because the billions and billions in our platform today are primarily on the public side. But what people are thirsting for are the alternative asset categories that are represented by everybody you see at this conference. And the ability to have those non-correlated assets in with a public portfolio that has assets that are otherwise correlated with public markets is really pretty powerful. And being able to extend that beyond just the P2P lending, but also into a whole variety of other asset classes is an important step forward. So we think that will be a real driver to expansion of the industry as a whole.
And our view on it is similar. We're trying to take an approach of sort of building out a business funding ecosystem, if you will, because we're in a good spot where we actually have access to 3,000 companies today that are trying to generally solicit and raise capital on AngelList, and we know that. And to the extent we can sort of funnel that into, if they can come through Lenvius, for example, and get their startup funding, then go to an AngelList or an early shares or a crowdfunder to get their equity their equity capital, and then go again to get operating capital back to the peer space. That would be really cool.
We're wrapping up pretty soon here. One last question for each one of you. I'd love each one of you to just answer it. In the next year, if we think about each one of your platforms, what is the number one thing that we should watch for in each one of your platforms? Anyone can start.
Yeah, I'll start out. I mean, I think it's really, from the technology perspective, everything being automated to the point where somebody could come and say, I'm starting a $200, $300 million fund, and I want to deploy it across 4 asset classes and 16 platforms. And for us to be able to say, we can do that without you having to hire a team of 100 people. It's really just making it easy and automating all the manual tasks that exist today.
We're going to look to support more platforms. We're really going to push this idea of standardization. In 2011, Nickel Steamroller started a website, p2pxml.com, which is designed to be an open standard for interchanging of data. We would really like to see the industry move to standards, and we would love to be a central aggregator for data so you can actually compare, like, how is Lending Club doing with Risk versus Prosper versus any other of the new companies that will come online to be key players in the future.
For our platform, we're looking to create the largest alternative lending network by aggregating different pools of product from different aggregators and different networks, and we're looking to do that globally. So by next year, we're hoping to have established a network in the UK and Australia and the US, and also in Northern Europe as well. So we can get that global allocation and order management automation. And we'll probably have a number of partners providing different models for each platform, working with us in parallel, and providing different types of analytics. So you'll see a lot more partnerships in the future, some leveraging each other's expertise and helping to grow this market, because it is big and there's a lot to go around. So sharing different expertise and core competencies is a way to move the market forward faster, because we do have a short window of opportunity to seize it and make it easy, and we're looking to do that.
I'll be quick because I know we're almost out of time. But yeah, on our platform, look out for more platforms coming on board, but more importantly, a marriage between the peer lending platforms and traditional finance and banking, which has to happen. So we're doing some interesting things around that.
We're going to measure our success by whether we can facilitate and enable a lot of other entrepreneurs to do some really interesting things. That's what we want to do. That's what we care about. And that's what we're going to focus on.
Excellent. With that, I'd like to thank all the panelists for joining us today.
Okay.